way I describe it is I don't see the information as negative information. Yes, we have yields going up, which is negative for the market, but yields are going up because the economy is improving. And so it's not just negative, it's a
business seems to be holding up better, given it's more of a staple good. Then there's a couple of Italian stocks in the luxury space. Bruno Cucinelli doing well, up 3.7%. That's cashmere sweaters, reporting some strong numbers this morning. But Salvatore Ferragamo, this is more in the shoe market. That is looking pretty weak, according to their trading update. And they are trying to do a bit of a turnaround in that business. There's worries that could potentially slow that down. Then speaking of sales in the UK, we got massively influential and as those weak numbers from September. The UK retail sales down almost 1% when you strip out the fuel costs in the last month. And we're also seeing declines in ASOS. That was one of the stocks that was halted an hour early yesterday. Potentially a bit more volume coming back in, but both of those declining following that UK data. A big dropper, meanwhile, is in bottle making. Very often, but we have got Ferrari, now this is listed in France and a couple of other exchanges as well, down almost 13% following sales update. That one looking very weak today. And I brought in BAE Systems following the US President's speech last night around both the wars that are ongoing. That one edging higher, but we have seen gains of 1% shares for obvious reasons over the past couple of weeks. Then on the final board, we've got a bit of a mix. So Sika, massive cement company, one of the world's biggest cement makers, reporting strong sales, potentially indicating strength in the construction sector. But a chemicals firm that is dropping. This is the fertilizer firm Yara over in Norway, down almost 5%. Again, earnings related to the earnings from chemicals over the next few weeks. We also had the auto numbers out of Europe up 11%, but we're not seeing again in many of those stocks.
This is markets today. Orders submitted. Order submitted.
And also, finally, I'm just going to go back to bottles, two bottle stocks, but Tomra, they actually make bottle recycling machinery.
What's been driving the run in treasury yields that you've seen of late? A lot of focus on the long end. Yesterday, we saw this market responding to Jerome Powell, and you're going to tell us what really has been driving for businesses, the unexpected theme of stocks on the move this morning. Joe, thank you very much for that. Joe Easton from our equities team. Let's focus in on the US economy and then broaden our conversation around global growth. The Fed Chair Jerome Powell has suggested the US Central Bank is inclined to hold interest rates steady again at its next meeting, but with the economy remaining resilient, he also left open the possibility of a future hike.
Considering that all that has happened with the inflation, you would think that the inflation risk...
There's a lot of uncertainty around that.
Surprisingly,
orders submitted, significantly last year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes.
Order
canceled. Risk management. Order canceled. Slowing down the pace to make sure that we are seeing the full effects.
Order submitted.
And that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we need to be, and now we're moving carefully to these decisions.
Order submitted.
Okay, and more recently we've seen, of course, Powell talking yesterday at the Economic Club in New York, talking to our David Weston, and some of his comments now filtering across the Atlantic, influencing markets here. How do you see the link?
I think with the numbers you laid out. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is?
Long-run potential growth is not something that moves around a lot over time, but my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour productivity growth, you get something around 2%, and that's higher than most other advanced economies.
Order submitted.
Let's talk about the US, the UK, global growth picture. Melanie Baker joins us, senior economist at Royal London Asset Management. Melanie, nice to have you on set with me this morning.
Okay,
We heard during
Orders
submitted. Orders filled. Orders filled.
Remember, you can get updates now.
Orders
Orders
strengthening MIT labour market, but at the same time, existing home sales coming in at their lowest. We will bring you further coverage of these markets on the pulse. This is Bloomberg.
Really develop. You also allow the averages to converge underneath whatever breakout channels you're looking at, and so just
order filled. Order submitted. Order filled. Order submitted. Order submitted. Order submitted. Order filled. Order submitted. Order canceled. Order canceled. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order filled. Order submitted. Order filled. Order canceled. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order canceled. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order filled.
Difficult for a central bank. Wage growth is still uncomfortably strong, I think, in the UK. If we do start seeing further deterioration in the labour market, yes, that can then give the central bank more confidence that we're going to see lower pay growth, but we're not quite there yet. We're starting to see a turn lower in the labour market, if you like. And as you say, pay growth is still too strong.
And what's your view, Melanie, on oil prices and how they feed into the risks for the economy? Because on the one hand, a higher oil price, mechanically might create more inflation. But given the cost of living crisis we're already in many places, a lot of people say actually it might act more like a tax. It might actually reduce growth rather than have a lasting upward impact on inflation. How do you think all of those dynamics will play out?
Yeah, it's really interesting.
Order submitted.
So in terms of the short term, absolutely, it will push inflation up. And we've already seen some of that with higher oil prices. But yes, it should be a dampener on growth, particularly in the European economies. So yes, in terms of the sort of medium-term impact, I'd expect that to be lower on inflation. The complication is we're in a high inflation environment in Europe. The worry is if you get big increases in petrol prices at the pump, that feeds through into inflation expectations, and it then doesn't have that same dampening effect. It just makes it a little more difficult, I think, for central banks to completely ignore, if you like, the
Order
higher
submitted.
risk at the moment.
And then the ECB, we should mention that. Their next meeting looms large, and I feel like we haven't talked about it all that much.
Order
I suppose the
filled.
expectation is they're on hold, and what else we need to know, Melanie?
No, absolutely. I mean, they've been reasonably clear, I think, in their signalling from last meeting that they thought this might probably
Order
be the
submitted.
peak in
Order
rates. And if
filled.
you look at how the data's been coming out in the euro area, we have
Order
a
submitted.
inflation surprise. Again, quite soggy, some quite soggy economic activity data. It doesn't look like there's anything that's going to kind of budge that on hold view. I've been watching it for something more on QT, on the PEP programme. It sounds
Order
like that's going to
filled.
be a topic of discussion. We might hear from Lagarde on that in the press conference.
Order
Okay, Melanie,
cancelled.
thanks so much. Thanks for joining us this Friday. Melanie Baker, Senior Economist at Royal London
Order
Asset
submitted.
Management. Coming up on the programme, we'll get back to the earnings stories, and one to note today, L'Oreal falling after the cosmetics giant posts a surprise slump in North Asia sales. We discuss the outlook for the European
Order
luxury
filled.
sector next. This is Bloomberg.
Order submitted. Order filled. Order submitted. Order filled. Order submitted. Order submitted. Order cancelled. Order filled. Order submitted. Order filled.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo
Order
closed its
submitted.
$11 billion all-stock merger with Athene
Order
Holding.
filled.
It had already owned 35%
Order
of the
submitted.
insurer.
Order submitted.
Here's what Apollo
Order
gets out of the
submitted. Order
Assets under
filled.
management. Apollo expects them to double to about $1 trillion by 2026.
Order
Much of that
filled.
projected growth
Order
will come
filled.
from the merger. And those
Order
assets
filled.
are especially attractive to
Order
Apollo.
submitted. Order
Insurance companies
cancelled.
typically go after much more modest returns than buyout investors. That will give Apollo more options for investing in
Order
cash.
filled.
Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to
Order
simplify its
submitted.
governance. It gave
Order
up its
filled.
dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Order submitted. Order filled.
All right. That is it.